Last week I gave you one specific call. I said watch the CFTC Commitment of Traders report on Friday. I said if managed money net longs in silver build meaningfully after the $70 break, that is institutional confirmation, not retail speculation, not momentum chasing, actual professional money deciding that $70 is a real level worth owning. That report came out. Net longs built significantly. The call hit. I am telling you that not to congratulate myself, I am telling you because what that confirmation means for where we are sitting right now is the entire point of this video. Because the paper market just told us something, and the physical market is telling us something completely different. And when those two things are pointing in the same direction at the same time, which they now are, that is when 15 years in these markets taught me to pay very close attention. Hold on to that thought, because in about 8 minutes I am going to show you a number from the COMEX warehouse data that stopped me cold when I pulled it up this week, and once you see it, the rest of this video is going to end very differently. I am John, 15 years in FX and commodity markets before I ever picked up a camera. I left that world because I believed the people watching their savings from home deserved the same level of analysis the institutions were getting. That is what we do here at Currency Insider. No sponsored content, no metals dealer behind the curtain, just publicly available data, named sources, and honest analysis, both sides of every story. Everything I show you today I will source by name as we go. If this is the kind of breakdown you have been looking for, hit the like button right now. It takes 1 second and it tells me to keep making these. And if you are not subscribed yet, do it now, because what we are building here week by week is a framework for reading these markets, not just reacting to headlines. Here is exactly what we are covering today. First, what a 15-year COMEX inventory low actually means in plain English and what it does not mean, because both matter. Second, why the simultaneous record open interest number is the part most channels are glossing over. And third, how the $77.99 Shanghai price against a $70.75 New York futures price tells a story about where physical silver actually wants to trade right now. Let me set the scene, because the price action this week requires some context before the data makes full sense. Silver spot is sitting at $70.56. Front month futures are at $70.75. Now here is the detail I want you to notice, and it is easy to miss if you are just watching the headline number. Spot is at $70.56. Futures are at $70.75. Normally futures trade above spot. You pay a premium for future delivery because of storage costs, financing, time value, that is called contango, and it is the normal state of a commodity market. When futures trade below spot, when the market is paying more for metal right now than for metal delivered later, that is called backwardation. We are not fully in backwardation yet, but we are flirting with it. The gap between spot and front month is razor thin. And in silver, when that gap compresses towards zero, it is often because physical demand in the present is so strong that it is pulling price away from what the paper market wants to assign it. Think of it like a hotel that is almost fully booked tonight. The room available right now costs more than the room available next month because the scarcity is happening now, not later. That compression is what the spot futures relationship is whispering to us this week. Drop your answer in the comments right now. Are you watching this move from the physical side, the futures side, or both? I read every single one, and the comment section here becomes a genuinely useful sentiment tracker week to week. Now let me get to the number that I mentioned at the top of this video, the one that stopped me when I pulled it up. COMEX silver registered inventory, and I want to be precise about this word registered because it matters. Registered inventory is not all the silver sitting in COMEX vaults. Registered is specifically the silver that has been designated as available for delivery against futures contracts. It is the pile that traders who sold futures contracts promising to deliver silver actually have access to, and that pile, according to the most recent CME warehouse report, has dropped to levels not seen in 15 years. 15 years. To put that in perspective, the last time COMEX registered silver inventory was this low. The iPhone had just launched, the financial crisis had not happened yet, and silver was trading in the mid-teens. The world has changed enormously since then. Industrial demand for silver has grown. Solar manufacturing has scaled. AI hardware has created new consumption categories that did not exist. And the registered pile available for delivery is back to where it was in that completely different world. Now here is the analogy I want you to hold in your mind for the rest of this video. Imagine a restaurant that has 100 tables. On a normal night, maybe 30 of those tables are reserved. The kitchen plans for 30. But tonight, someone has taken reservations for 95 tables, and the kitchen has only stocked ingredients for 40. Most of those reservation holders will cancel before service. But if even 20% of them show up expecting their meal, the kitchen is in trouble. That is COMEX right now. Record open interest means a record number of futures contracts exist, a record number of paper promises to deliver silver against a 15-year low in the silver actually available to honor those promises. Most of those contracts will roll or cash settle. They will not demand physical delivery, but the ones that do, and in a market with this kind of supply pressure, that number tends to grow, those are the ones that create the squeeze. Here is where I want to show you the other side because I said both sides and I mean it. The commercial shorts on COMEX are not stupid. These are sophisticated institutional traders, banks, producers, refiners who have been short silver futures as a hedge for decades. They know the inventory numbers, they have risk management. Teams, they have access to capital. When margin pressure builds, they have tools retail investors do not have. They can roll positions, source metal from other venues, negotiate off exchange. A short squeeze in silver is not a foregone conclusion just because the setup looks tight. I have watched this setup build before and resolve without a dramatic price event because the commercial side found a way to manage it quietly. What is different this time, and I want to be careful here because I am not making a guarantee, what is different is the combination. Low inventory is not new. Record open interest is not new. A 10% Shanghai premium pulling metal eastward is not new in isolation, but all three at the same time while the dollar is under pressure and yields are elevated but not crushing metals, that specific combination is unusual, and that is why I am flagging it, if you know. Someone who has been sitting on physical silver wondering whether the setup they bought into is actually developing, share this video with them right now. This is exactly the kind of breakdown they need to see. Now let me bring in the layer that connects everything because silver does not move in isolation and the macro picture this week has added a dimension that changes the usual yield story. Normally when I show you a 10-year treasury yield at 4.41%, the narrative writes itself. High yields mean money flows to bonds away from non-yielding assets like silver and gold. That is the textbook relationship, and it has been broadly true for decades. But look at what silver is doing. It is holding above $70 against a 4.41% yield environment. Something is overriding the yield headwind, and that something, according to multiple institutional research desks, is what traders are calling a war premium. Oil prices have been moving on Iran conflict headlines. When oil moves on geopolitical risk, the inflation expectations embedded in commodity markets shift. Silver gets repriced not just as a monetary metal, not just as an industrial input, but as an inflation-sensitive asset that sits at the intersection of both. The Bank of England has been watching this dynamic carefully. UK inflation remains sticky, and the LBMA Vault data out of London continues to show institutional interest in physical silver and gold as real asset allocation tools, not just speculative positions. For British investors holding silver in a SIP or a vaulted account, the combination of sterling weakness risk, UK inflation stickiness, and the global war premium on commodities creates a genuinely different context than the simple yield headwind story suggests. De-dollarization is a decade-long structural process. It is not a Tuesday event, but the direction of travel is visible in the data. World Gold Council central bank buying has been consistent and multi-year, and silver is increasingly being caught in that same gravitational pull. Let me say something quickly about the industrial side because it matters for how you frame the Shanghai number. The $77.99 price on the Shanghai Gold Exchange against the $70.75 New York futures price is a $7.24 gap. That is a 10.23% divergence. Now the honest version of what that means is this. Part of that gap reflects genuine physical demand from Chinese manufacturers and institutional buyers who need silver now and are paying up for it. Part of it reflects local market structure, import costs, and financing. I am not going to tell you all of it is pure physical scarcity because that would be overstating the case. What I will tell you is this. The Silver Institute has been tracking industrial offtake from China in solar panel manufacturing, EV components, and electronics assembly. That demand is real, it is scale, and it has not reversed. When Chinese manufacturers are paying $77.99 for silver that New York is pricing at $70.75, the arbitrage is so large that it becomes economically rational to physically move metal from west to east, and physically moved metal does not come back quickly. It enters the eastern supply chain, which means the already thin COMEX registered pile gets thinner. Silver is not like oil where you can watch it burning. It disappears into circuit boards and solar cells, and it rarely comes back in a form that returns to the COMEX registered inventory. That directional flow matters. Alright, 3 lanes. Let me show you exactly how I am reading this week. Lane 1, the paper market, the blue lane. CFTC data confirmed last week that managed money net longs built significantly after the $70 break. That is the institutional paper market voting with real money that $70 is a meaningful level, open interest. At record highs means the total volume of futures bets is at a historic peak, which amplifies any move in either direction. The paper lane is loaded, lane to the physical market, the silver lane, COMEX registered inventory at a 15-year low, Shanghai premium at 10.23%. Physical metal flowing eastward. The Royal Mint in the UK reporting continued retail demand for silver bullion. The physical lane is tight. Lane 3, the macro lane, the gold lane, DXY under quiet pressure at 100.07. 10-year yield at 4.41% elevated but not breaking silver. War premium on oil adding an inflation layer. World Gold Council central bank accumulation continuing. The macro lane is pointing toward hard assets. In 15 years watching currency and commodity markets, the times I have seen all three lanes align in the same direction even briefly have historically preceded some of the most significant moves in these markets. I am not saying we are there today. What I am saying is that right now all three lanes are not contradicting each other. That is worth paying attention to. When the paper lane is loaded with record open interest, the physical lane is tight at a 15-year low, and the macro lane is pointing toward real assets, the historical pattern has been that the paper market eventually reconciles with physical reality. Framework, not forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing, I am watching the COMEX registered inventory number on the next CME warehouse report. Specifically, I am watching whether it crosses below the threshold that triggers what the exchange calls a notice day concern, the point at which the ratio of open interest to registered inventory becomes statistically unusual enough that the exchange itself pays closer attention to delivery dynamics. I am not going to give you a specific ounce number here because I want you to pull the CME warehouse report yourself and find the registered column, not the eligible column, the registered column, and watch that number this week. If it drops further while open interest stays elevated or builds, that is the confirmation signal I am watching for. If registered inventory stabilizes or ticks up, meaning new silver is being designated for delivery, that releases some of the pressure and changes the near-term picture, that is the metric. That is the report. That is exactly what I am looking for this week. This is my one call, John FX Insider. On record, I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I give you both sides without picking one, because your job is not to find a channel that tells you what to believe. Your job is to watch the conditions develop in real time. Here is what needs to happen for the optimistic picture to develop. COMEX registered inventory continues to fall. Open interest holds at elevated levels or builds further. The Shanghai premium stays above 8%. The dollar fails to reclaim meaningful strength above 101 on the DXY. If those four things develop together over the next 2 to 3 weeks, the structural case for a significant silver repricing becomes very difficult to argue against. Here is what needs to happen for the cautious picture. Instead, commercial shorts find a way to source metal and register it at COMEX, relieving the delivery pressure quietly. Open interest begins to unwind as traders roll to later months. The Shanghai premium compresses as Chinese demand normalizes or import costs shift, and the Iran situation de-escalates, removing the war premium from oil and by extension from silver's inflation repricing. If that develops, the $70 level may prove to be the top of this leg rather than the launchpad for the next one. Both outcomes are genuinely possible. The data right now favors attention, not panic, not euphoria, attention. Watch the registered inventory number. Watch the COT report Friday. Watch the Shanghai premium. Those three data points will tell you more about what is actually happening than any headline will. Before we close, the disclaimer you need to hear, and I mean every word of it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things and I genuinely want your answers. First, are you currently watching COMEX registered inventory yourself? And if so, what are you seeing at your local dealer in terms of premiums and availability right now? Second, do you think the commercial shorts find a way to manage this quietly as they have before, or does this combination of low inventory and record open interest feel different to you? Drop both answers below. The comment section here is a real-time sentiment tracker and I read every single one. Subscribe because next week I am going to walk you through the CME warehouse report line by line. I am going to show you exactly how to find the registered inventory number, what the eligible column means, and why most retail investors are reading the wrong column entirely. That is a skill that changes how you follow this market permanently. And if someone in your life is holding silver right now and trying to make sense of whether this setup is real or just noise, share this video with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.